You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions@TheOptionsInsider.com.
I would like to welcome back Andy Nybo to the stage for our next presentation, Managing Operational Risk in a New Era of Regulatory Oversight. Come on.
Thanks, Patty, and thank you guys once again for sticking around. Because there's no windows in this room, so that's a big part of the attendance here. Plus, we got a great panel, great topics. We've had a number of setup calls for this panel, and it's one of those panels where I'm just going to, kick it off and let these guys go on about what all the issues are that are impacting our market from an operational perspective, risk perspective. It's near and dear to a lot of the firms in this room. It impacts the transaction chain from start to finish. We came up with a long list of items, and we whittled it down to a couple of items that are really critical for the industry to be aware of and be engaged with to better understand how it can and will impact our industry. I alluded to some of them in my session earlier this morning. The Exchange Leaders panel talked a lot about them, and you guys are reading about this day to day. But the two topics that kind of made it to the top of the heap were RWA, risk-weighted assets calculations, and then risk controls at the exchanges. All around capital charges, efficiency of capital, and using capital that is so near and dear on the balance sheet these days. So to start with, I'm going to introduce the panelists here. They can tell you who they are, what firm they're with, and kind of what their role is, and then we'll jump right into the discussion. So, Kevin, why don't you start?
Sure. Kevin McCarthy from Merrill Lynch Professional Clearing and Broker Clearing for Bank of America.
Slade Winchester with Citigroup. I work on our electronic option router, and I work very closely with our option market maker on market structure and providing liquidity.
My name is Jim Radecki. I'm Managing Director at Goldman Sachs. I'm the Midwest Regional Manager for our Prime Services offering and one of the co-heads of our global clearing business.
I am John Fennell, and I run risk management for the Options Clearing Corporation.
Great. Thanks, guys. So RWA, we hear that acronym all the time, and I thought we'd start this off a little bit, but we'd get a little bit deeper into what RWA is and kind of the history and why it's so critical to our industry right now. And James, you want to kind of kick it off and give the short history or medium history of RWA and where it comes from and why it's so critical?
Yeah, thank you, Andy, and thank you to Patty Schuler, Box, all the team at the Box, Eddie Boyle, everybody for putting this on. It's a good venue, a good set of content today. The Basel Committee put together its commission on Basel III standards to address post-crisis what they wanted their new standards to be for making sure that the crisis that we went through didn't happen again. In doing so, they took kind of some of the tenets of Basel I, 1.5, and 2, and took a look at. They wanted to get to the banking system in three specific areas. First and foremost, they wanted the banks to put up more capital. Get it? Okay, it's going to cost you more, but you have to put up more capital. Second, they wanted to address the fire sales of banks that were seemingly had billions of dollars in liquidity, and the next day it was gone. And the third was they wanted to address the leverage inherent into the interconnectedness of the banking system and go at it in those routes. And so I think the banks having to put up more capital, that was one issue. I think what they did is in some of the tenets of Basel III, they pushed out the duration of funding. So it used to be that you could borrow everything in the overnight market. Now the minimum is 30 days, but most of the banks are actually running more towards 180 days in liquidity. And just do the math and look at the difference between the cost of overnight Fed funds and 6-month LIBOR, say. And that's where the evolution of how the impact of this regulation kind of started and what everybody focused on. But most interesting was when they put in how to address the leverage in the banking system, they came out with a series and a set of leverage ratios that they proposed that the banking system would now be held to. First and foremost, there was the supplemental leverage ratio. Then they came in with the standardized and advanced methodology RWA calculations. NSFR was following on top of that, and LCR, and we won't get into any of those. But what made these interesting is they were having a phase-in period between when they came out in 2010 and rolling them out into full phase in 2018, is they made a lot of them reportable on a monitoring-only basis beginning in 2012. Well, but what they did is they made them reportable in the quarterly earnings reports of the banks, so therefore you're instantly held to them. And what they basically are saying is, okay, go ahead, mess with the leverage ratio, we'll let the market dictate how much your stock drops. So at some point in time, what they're essentially doing is saying there's no price with which you can flirt with that ratio. You've got to stay within those ratios. And it created a set of challenges. But in the United States, when in 2010, when the mandate came out, the Fed had to adopt its version of Basel into our rulings. And in the 11th hour, Senator Collins from Maine came in with what's now known as the Collins Amendment. And what the Collins Amendment did, it assumed that most of the banks, because we're all kind of compute risk metrics, would go to the advanced methodology. But Senator Collins slipped in and had legislated into, as the Collins Amendment to the Dodd-Frank, that what's now referred to as the Collins floor, which you denying access to getting away from just relying on the risk-based methodology, that you essentially are bound by both the standardized and the advanced methodologies. And the advanced methodology is based on your individual bank's model adapted to the process. The standardized methodology is it's what I'll call draconian. It's a strategy-based methodology based on gross notional value that allows for no netting. And what the Collins floor put in there, saying that you have a minimum standard, which is going to be the standardized methodology, what the Collins floor actually did was create the Collins cap, which is a cap on how much leverage that you can run in these balance sheet portfolios. And so the Collins Amendment is something that really is stuck because it got legislated into Dodd-Frank. And so and to give you an example of how bad the standardized RWA calculation is, it essentially grosses up your options portfolio and how it impacts the liquidity provider. It grosses up your options portfolio by notional value by strike. So, for example, in a big contract like the SPX, and you have a lot of big strikes out there, it takes the gross notional value of your shorts, takes away the offset that you get for the longs, and then you have a balance sheet requirement based on that calculation. So that it's clear when this was written that it didn't contemplate the provision of liquidity and what it would mean to that in the second and third derivative of the application of this regulation. So the things we talked about, the things that keep us up at night, and we have various different things to talk about on this panel. But for me, I've always been a defender of the market maker, the liquidity provider. And when you look at the draconian nature of how this regulation plays out into reality, and it went into effect in full reporting phase in January of this year, it has the impact of essentially putting onto the banks how to generate a return for the equity that they have to use to support that balance sheet calculation. And when you contemplate all the different leverage ratios that go into it, it's a very big binding constraint for the market maker. And what's been proposed out there is Basel said, okay, look, we realize there's shortcomings to this, and we'll come back with something, in some other panels have referred to it, the standardized approach to counterparty credit risk, SACR. That's proposed by Basel to be available to the community in January of 2017. But to our knowledge, the Fed hasn't really started adapting what it has to do for that. So we actually believe that the next step would be ultimately to come up with a market maker or liquidity provider allowance for netting, a collateral enforceability that in language in the documents would allow for that, because otherwise the ability for liquidity providers to continue to make markets the longer we go, if the Fed doesn't get to SACR until 2018, the banks and the clearers of these transactions will have increasing pressure on how to attribute equity to that balance sheet usage. So there's a lot more detail behind it, but that's what keeps me up at night most nights.
Okay. And I was a gloom and doom guy this morning, so that's refreshing to hear. Kevin, how does it impact what you're doing in your firm and how you serve kind of your clients? What impact does this whole Collins Amendment RWA have on what you guys are doing?
Well, I think Jim laid it out really, really well, understanding the depth of RWA, the impact, what the impact it has on the bank, and how does that translate back out to our client base. And there's been a significant amount of conversation that happens around the formula, working with OCC and others to try to work out the process around how that formula will come into play over a period of time with the netting that we have historically been able to leverage and extend out to our client base. Now with the conversation really playing into how to educate the client base, what does it mean, what are the constraints of Basel III, how does it apply to the bank standards that we have, what does it mean to an allocation of balance sheet? So as Jim rightly points out, the liquidity is one aspect, the equity is another, the balance sheet allocation, which I don't think is unknown to any of our audience here and others, has really been a significant challenge to us. And that really comes back down to, are these strategies that are deployed fundable in what manner, over what historical or what future point of time? What are the data points that we need? So we start to get into a different level of operational items that we haven't seen before. One, coming up to the curve around what these regulations mean, how do we calculate it, and then looking into the strategies in the portfolios, what does that tell us? Will that change the behavior of a particular client? So there's been a significant amount of education that we've had to go out into the marketplace with because there's really not that many of us that are really aggregating some of these issues.
So, I mean, the client base, the market makers, liquidity providers, and you talk to your clients on an ongoing basis. Slade, from your perspective, big liquidity provider out there, big, Fed bank holding company.
It's created a new Greek, basically, in the marketplace that the traders have to manage to. They have very strict balance sheet usage per stock, per position that they have to manage to now. Where before that was not really a thought process that they had. It was really around your delta, your gamma, your traditional Greeks. And now I know that we've mandated certain capital usage allotments per trader, and if they violate that, they're getting not the stick out but the baseball bat and saying you've got to reduce. Which there's been a lot of the cause and effect around wider markets, but there's no question in my mind that causes wider markets. When you're really being mandated to reduce your long stock position. You're not going to want to sell calls and buy stock against that. You're going to need to adjust your interest rates in your system so that you're not doing that, and you're unwinding some of the balance sheet usage you have on. So you're going to move off of markets in different ways. So it's definitely going to have an effect going forward. And I think that's really part of the widening that we're seeing, not just the auctions that everyone's talking about. There's a lot of different factors all coming to a head at similar times here. So it's definitely an interesting time.
John, from the OCC's perspective, what how does this play into what you guys are doing in your roles of risk, risk management over there? What's your perspective? How are you dealing with this?
Yeah, no, I think we look at these issues more from a systemic perspective, right? We're looking at these capital charges having such an impact on our really 2 to 3 largest clearing firms who clear all of our liquidity providers, and their ability to kind of going forward basis on their balance sheet still be able to clear that. We think that absent some change, you're going to see some fragmentation where either a certain level of the liquidity providers are not going to be able to be, you're losing the efficiencies that these 2 large clearing firms provide, and they're going to have to go either direct self-clearing or shrink, and in the end, that really, I think, is a negative trend for the options market. When we look at this RWA issue, that's an example of regulation that started far away at a very high level, trying to solve a problem. And as you started getting down and down into the implementation, the speed that regulatory change was implemented was very quickly, and it's a good example of an unintended consequence, where once you go from vision down to implementation, inserting that one Collins amendment where it basically said you have to take the most conservative capital treatment of any of the other formulas. They did not contemplate option markets at all, and it's having these kind of effects on our markets. The liquidity is severely getting damaged from that.
Are we in the first inning of this story or game? Is it, the provisions around, the risk and capital charges coming out of Basel III? Is it just beginning to get felt, or is there worse to come down the road?
I think we've been feeling it, but I think that some of the banks and others have been absorbing the conversations, trying to make sure that we provide some insulation to the clients. But now it's more of taking effect, and how does that ultimately translate to additional costs to the market makers and others? So I think it's just starting to come into play, and we're going to see more and more aspects of creating better liquidity, more capital charges, additional ability for the clearing corps to sustain any type of event in the market. And as an aggregator around some of that risk, I think that this is where it's really starting to pick up some momentum.
Jim, what are your clients saying, when you have these conversations and try to communicate the changes that are coming?
Some of it I can't repeat. I think it's a work in progress. I think what everybody realizes is that we have a vested interest in the provision of liquidity. That's where you start. You look at these conversations. There's a responsibility in that. And when you look at the hazard that the banks face in trying to make sense of these regulations, first and foremost, when you do your balance sheet calculation in your quarterly earnings reports, you now have 7 different calculations you have to do. From economic balance sheet, you have to calculate your supplemental balance sheet leverage ratio. You have both of your RWA calculations. You have NSFR, LCR. And when you get through these calculations, you realize that one transaction can pull a risk-based, your binding constraint in one transaction can be a risk-based calculation, and another single transaction can be a leverage-based calculation. And each bank, based on the businesses that they're in, has a unique and different set that can make one bank's binding constraint different from another, and different businesses within those banks have different can each have different binding constraints as well. So I think what we've done since starting in about 2010 was to try to come up with a methodology to come up with a weighted probability of what your binding constraints are going to be that normalizes you to be able to understand how you're allocating capital to support the balance sheet of your different businesses. That was a big part of it. Another one was educating people on how you're going to do that, in many cases, before you know exactly what your strategy is going to be. We use an attributed equity model at Goldman Sachs that we've come up with to make sense of this so that we can compare a client in one business to another and say that's how we're deploying the capital. I think from the client perspective, the most of the feedback that we've gotten and we think is with it is the regulators within this industry underestimated how impactful this stuff can be to liquidity. How impactful the second and third derivative of this will be. For example, the collateral haircuts. The standardized methodology is just broken when it doesn't allow for netting. But if you look at options that are less than a year, carry a 6% collateral haircut. Options between 1 year and 5 years carry an 8% collateral haircut, and options for greater than 5 years aimed at the over-the-counter derivatives market are at a 10% collateral haircut. That impacts the LEAPS players out there in ways that people hadn't really thought about, but they carry a much higher RWA. So if you have LEAPS players in an index book, you start really multiplying the balance sheet impact of a particular client. So now that we're building the tools to be able to specifically attribute to specific strikes and things in portfolios, we're going out with another round of education saying, okay, there's things that we can do before we get the OIC to get with us and address the liquidity issues that this is putting on the marketplace in terms of per minute offset, a market maker exception that we need to get together as an industry and solve these issues, because this is an industry-wide issue that we're taking a lead on. But the other side of the coin is that you have to give the right tools to the liquidity providers in the industry to be able to show them how to optimize their portfolios within there. In some cases, it's avoiding high strikes. There's things like that will be very simple impacts to the denominator that can be very meaningful. So Our clients, I think, have been very professional, very understanding. We all, our interests are all aligned in that we've been able to show this is not a get-rich-quick scheme. This is keep up with the pace of regulation and try to stay on that mark to keep all the liquidity providers providing liquidity that they expect to be able to do.
I think it's a consistent message across the entire street. So when Jim goes or Kevin goes and talks to a client, that your costs are the cost to access a large bank's balance sheet is going up, and we're going to be very exclusive with how we dole that out to the street in general. That's happening. I think you touched on it this morning, Andy, that even the institutional trade desks are being very careful with how they allow customers to access their balance sheet. So they're going to be stingy with it until we all fully understand all the implications of these things, because you don't want to put on some 8-year position and realize you have to fund it in a way that's going to lose money.
So Slade, just kind of digging into that, you run around the trading floor with a baseball bat, breaking windows, yelling at people when they're...
Brett does, our head trader. But
Yeah. What kind of tools are you using? Are you using provided tools? Are you building your own?
We're building our own.
Okay.
Yeah, but it is literally new Greeks that
Right.
that you're having to look at, and there's a lot of pressure on the traders to make sure that they stay within the bounds, because we can't violate our clearing firms, limits they imposed on us.
Jim made a good point when he said that people didn't contemplate the second or third or fourth derivatives of this change. I think that's important from the perspective of when you start thinking about regulation that starts far away. They don't have a vision of the detail on how a liquidity provider is financed, how he manages book, how a bank allocates their capital to a liquidity provider. So when they're coming up with rules to deleverage the system or break contagion, they're not thinking of the second and third degrees. Second, once something's gone further enough down the path to implementation, it's really hard to change. That's why what everybody's kind of talking about on the panel isn't how do we fix the problem, it's how do we react to the problem and how do we manage within the problem. I think what we're trying to do from a clearing perspective and an industry perspective, and where you need help, is to look at these things as they're forming, as the policy is forming in Europe and with the global regulators, to bring awareness to these issues, these second and third degree issues, and what the downstream ramifications are, trying to get in front of that. Our RWA is something that got all the way through, and now we're trying to look at pendulums over here. Now how can we start bringing it back? Jim mentioned SACR as an option. That doesn't bring it probably back where we want it to be, but it's a point, and how can we start influencing that change now so that when we get to 2017, 2018, we're in a position where it's at least digestible. And then I think as an industry, clearing houses, clearing firms, liquidity providers, exchanges, really looking at, as policy is forming, trying to be really engaged in that process so that we don't end up with a product in the end that damages us.
So engaging in the process, is it, the pendulum's gone way out here. How does industry get back engaged? How do we, you just can't keep saying no to the regulators, right? It's not a winning proposition, but how do you push back? Is it education? Is it, coming as an industry group, as through the OCC, OIC?
We look at it as through different industry groups. I think we've got our securities coalition as one point of entry, where at least on RWA, we've been trying to go to the regulators and highlight, bring awareness to this issue. And I think we've done a good job of that. So I think they know where the flaws of the calculation are. But from their perspective, it's so hard to affect change in a short period that there's really nothing they can do about it in the short term. So they're looking at SACR. And again, now's the time to really be looking at that calculation and make sure there's nothing else in there that's going to have unintended consequences. So I think through either our securities coalition, I think the different industry panels, FIA and SIFMA, do a really good job of trying to bring awareness to these changes early on. I think people need to be engaged in that process, and I think people need to be vocal.
Mm-hmm. I think it'd be interesting if there's the Equity Market Structure Committee as part of the SEC working group, I think it is. If there was a option-like group that went to the SEC and brought some of these real structural issues and opened them up so that the SEC could really understand them, and that they mandated that this is part of a good process to educate and to make well thought out change, because the people are making changes where they don't understand all the full ramifications of some of these things. So I would be really interested in exploring how one could do that. I think that maybe came up on the industry leaders panel this morning, or the exchange leader panel this morning, that options are really an afterthought at the SEC, and we're laying out not the prettiest picture for liquidity going forward, and so we need to really go in with a full force of trying to educate people as some of our the industry's concerns, because I'd like to work in this industry for another 15 years or so. I mean,
we'd like that too, Slade.
So the other kind of what keeps you up at night topic that popped up in our calls was the risk controls at exchanges, limit up, limit down, all those kinds of things, standardization, harmonization of policies. So touching on that, where are we with that from where you guys sit? Are we in a good place? Is there more work to be done? I'll start with you, Kevin, on that.
I think there's a lot more work to be done. Jim and I have spent some time on this. We've talked to the various exchanges. There are many venues beyond the options exchanges that we have to speak with. The education level is much better. I think the interaction level is better, meaning that there was a little bit of a resistance, right? Why do you need this information? What's the transparency? What are you looking for? And I think what we've gotten to now, and part of the whole reason for this discussion in the panel is the other panels have discussed as well, and that is we need a little bit more standardization. This should not be a competitive issue. We want to protect the markets. We want to protect the clients. We would like to be in business as well. And the standardization of that risk layer, the monitoring, transparency, and consistency across the exchanges by products is really something that could benefit us as we respond to these new regulatory aspects and provide that service to our clients. So, just as simple as exchange protocol. When it's different, and we're building that across 5, 6, 7, 8, 10, 12, 14 exchanges, that's a build. That's a cost. That's a time and an effort need. So I think that what we need to do as an industry, just holistically, get back together, come up with some creative standardization that works, that can work across the client base, be centralized with the CCPs and others, and I think that will really benefit the overall community.
John, how about from where you sit? Where are we in this baseball game? How close are we? Are we getting along? Are there big challenges that still remain?
Yeah, I think it's an evolving process. I think I'd actually kind of describe this kind of the pre-trade risk controls in the markets as something that, from how it developed, was something more the model. I think you see on the future side, they've got a lot of pre-trade controls, and it's easier to implement that. You've got a vertical model, one exchange, one clearinghouse, and so the challenges really aren't there that you see in our model, where it's 12 markets feeding into one clearinghouse. I think from our perspective, what we really tried to do is engage clearing firms, exchanges together, and to build a framework that wasn't prescriptive. It was intended to allow each of the different markets with their different execution kind of models to be able to thrive, but at the same time have the safety and sound controls in place and all operate to a certain level. Now, we've gone through the process of defining what those principles would be. We're in the process of setting up our evaluation of the markets so that we can have a consistent way of evaluating each of the markets. I think in the beginning there was some resistance, but there's always resistance to change. But I'd say right now what we're sensing is kind of the opposite. Now the exchanges want to be the first one out there, the first one to meet in the standards. And I think what we found is that kind of momentum and pressure has caused everybody to really allocate resources to it. I think we're in a much better place than we were a year ago. And I think we're going to continue to continue to evolve down that path. And I think a lot of it has to do with kind of creating the standardized framework that wasn't prescriptive, that allows each market to kind of grow in its own way, but allowed the back-end office providers to have confidence that there's some equal level of resiliency there.
In terms of timelines, is there a drop-dead date? Is there an official timeline? Are we 1 year, 2 years out on kind of 90% there?
So we are in the process of rolling out kind of that examination process to make sure each of the exchanges have different kind of controls, activity-based controls, pre-trade, price reasonability, drill-throughs, and kill switches. So those are kind of the 4 categories we came up with. The drop-dead date is June of next year. So we're putting these controls in. We're going to be evaluating what the exchanges have in place. And then we're going to be very public about which exchanges are meeting the bar and which ones aren't. And in June is when the penalty actually kicks in. And under the proposal, there would be an additional charge for exchanges that aren't compliant.
June 16.
June of 2016, yeah.
Okay. So how about from where you said you're providing markets on a lot of these exchanges? What's your perspective on the state of play as far as risk controls and what needs to be thought through a little more?
We're big fans of the pre-trade risk controls. If you can define an obvious error in a rule that's well written, can we, as an industry, not allow those trades to occur in the first place? We have limit up, limit down in the equity market. I know it's a lot different in this product base, but I'm really concerned as a part of a large financial institution, and these are a couple of large financial institution clearing firms, that what I call the innocent bystander. Person who's just standing there, you have your markets out in the marketplace, and then next thing you know, you're long $300 million deltas, and it was obvious an error by someone in the marketplace, and you're not sure whether to hedge it, not to hedge it. These are all things that you have to decide in seconds about what you want to do. Get on the phone with the exchanges. It's very messy and very scary, and it's really uncomfortable to call up the head of trading in New York and say, yeah, we're long $300 million deltas. We haven't hedged them. We think they're going to get busted, but we're not sure what's going on. Like, excuse me, they're not going to take that many phone calls like that before they say, you know what, I don't like this business, because next time it's going to be $1 billion. And then same thing, it rolls down to the clearing firm. How good are your customers to be able to guarantee that kind of risk ultimately? So the pre-trade risk control to me, I know is a very big lift for the industry, but it seems like long term we're going to have to do it. There's too much risk. So
I think from the ultimate end consumer of the options product needs it. It's that uncertainty is what it victimizes the marketplace. People need to know when a trade's a trade. And I agree with Slade, and we've always agreed on this. I think we've talked about this for years. The extent to which we can get things to stop being bad trades before they get through the gateway into the matching engine in the marketplace, everybody is going to be better off. And look, we're all in this for safety and soundness. Like Slade said, and Kevin and I have talked about this, John and I have talked about this. All I need to do to continue to work in this industry is have it be safe and sound and not blow itself up, right. For all intents and purposes. And the truth of the matter is every one of these crises that hit the industry, whether you are a trader or not, whether you're at a firm that had an issue go on in it or not, or you're at that clearing firm or not, you have the adjacency risk now to any of these things happening. We need to address this from top to bottom, from end user all the way up to the regulators, and everybody has a role in this because you don't know when the next one's going to be the one that really has an impact on the use of options is an investment strategy broadly. So I think that's the real big threat to our industry is that we all have the adjacency risk to each other. So if we do, we might as well come to industry solutions and have it not be a competitive issue. And I think on that, I'd like to see the SEC actually have a firm view in this at some point in time, and we really haven't seen that. And I think that it would be we'd like to see that from the top down without, again, and we don't view it as a competitive issue. We view it as a safety and soundness issue. And I think the last point on that is from a clearing firm perspective, one of the things that we're because we know when we clear market maker A and market maker B, market maker A needs to be able to look at us in the eye and say, we need you to know that you have the right protections in place for market maker B because that guy can take us out too. Even though we're doing everything right, we can't be out there. So we're probably going to take a much more, some of the things that we've tried to gently focus on is increase the transparency with the exchanges of understanding what their controls are and adapting the right best practices and controls. But then B, getting transparency into how they're deployed, how they're being set, how the market maker, the quarter, or the router are using them. And then ultimately, I think we like the Merck's methodology where when somebody does have an issue and they get taken out on a cancel and disconnect, before they can come back in with us as having the ultimate Amex Black Card on the TABB for the clearing of those transactions is that ultimately we have a say in the protocol for how that line gets reconnected. Make sure that we've talked to the technology people, because there's human things that can go wrong beyond the technology in this. So ultimately having the clearing say working with the liquidity provider on engaging back into the marketplace rather than having somebody out there just hitting buttons, turning things on and off. We think that's another additional sound practice for the industry to take on.
Don't you run the risk, though, of cancel and disconnect, and then there's a manual process to get reconnected and get your orders back in the market? What if you're really long, you're really short, and you got to be back in the market really quickly, and the market's moving up or down?
Well, it depends on and I think the market makers have gotten really good at this. It's different from, and I'll let Slade comment on this, because I think it's slightly different from the order routing perspective as it is from the quoting perspective. Most from the QRM, if you're using really smart QRM settings, in activity-based settings based on number of contracts or multiple ticks, things of that nature, most of the liquidity providers, they value their money more than we do. And what they're essentially doing is they're taking themselves out of that market automatically. What we want to say is we want to understand that you're good too before you go back in. So I think for the most part, the market makers are taking themselves out. Well, how about from the order routing perspective?
Well, from the market making side, it's get out first and figure out what happened later. But if you feel like something's going wrong, you get out and stay out until you really understand what happened in there. And the order routing side is, I'd say it's not as sophisticated as the market-making side, and there's definitely work to do on the order routing side.
Are we still are we still? Could there be a possibility a rogue algo could just go off again, and we're not going to catch it? Are we safe there yet?
Oh, absolutely, 100%.
That was Slade Winchester.
That was a joke. I mean, of course. I mean, unfortunately, we're all at risk on that. And we. I mean, I say the order routing controls aren't as sophisticated as the option controls. We have very sophisticated controls around our order routing and watching volume as it comes over the market. It's going to keep getting better though as it goes on. There's less dollars at risk because you just have so many quotes in the marketplace, as we were talking about earlier, with 1 million products listed at OCC across 14 exchanges.
So we have that June 16 date out there. Are there any other milestone dates before that we should be paying attention to and aware of? Or is it just an ongoing process with exchanges having different?
No, I think it's mostly just going through that process. I think we want to be thoughtful on that. It's the first time through, so I think I would expect that most of the exchanges should largely be through kind of the process during the first quarter and have lots of time to well before the June date before. Because at the same time, our objective, we don't want to charge firm exchanges more for these contracts. We want everybody to make it. So I think what we want to be doing during this time is evaluating, finding out where their weak spots, give the exchanges plenty of time to fix those gaps so that come June that everybody's rolling with a sound system. I think it's about, I think Jim laid it out best, is that this market is all of our markets. It's the clearing houses, clearing firms, liquidity providers, and the exchanges, and we all need to do our role. I really like how everybody's taking really a thoughtful risk perspective around maintaining the market and make sure this is a market we can all work in and live off of for the next 20, 30, 50 years. I think we really have to have that perspective, and the short-term gains of having gaps or not having really resilient areas, or doesn't have the long-term payout there.
Okay. We have a couple minutes left here. Are there any questions from the audience for our panelists today? And I can't see very well, so if you have a question, shout and jump up and down.
I had one that came in that asked why John Fennell's the only one up here without a beard. and I think
I'm just a clean-living, clean-shaven guy.
It isn't the fact that you're not growing the beard until the OCC capital plan goes into effect. You just didn't get the memo.
I thought we said we were talking about that.
Okay.
Any other beard questions out there? Because I was wondering the same thing a couple seconds ago.
Hey, you're not off the hook either, Andy.
Well, hey, I'm just a moderator, man. Other questions? No?
Other questions?
Going once, twice? Then I'm going to call it a close here. Thanks very much for you all attending this afternoon. Thank you, guys.
Thank you.
Go Blackhawks.
Go on.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.